You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Wednesday. I get this question a lot, and I thought of doing a quick episode on it. And on top of that, giving you even more information about the Brookfield family. So first things first, the question, quite simple. I'm thinking of investing into Brookfield Corporation or Brookfield Asset Management. So Brookfield Corporation, ticker is BN. The Brookfield Asset Management is BAM as in mother. So that question came from one of my DSR members, but it's kind of like a recurring question. A lot of people ask questions about those companies. They're quite confusing. And actually, I did a complete review. So if you want to skip yourself the podcast and you want to dive in, you can go to moosemarkets.com/newsletter. And by subscribing to Moose Markets newsletters, you will get access to a secret resource page where I do have a complete overview of the Brookfield. I did it last year. It's a year ago, and it is still very accurate because I'm talking about the business models, not the recent numbers. And the most important part here is how to make the difference between each of those companies, because they're all connected, but they're not the same. And the business model and how they are affected by the market and other events are completely different. That's why it's important to understand. So today we're going to take a little bit more deeper into BAM and BN. So the big question here is, would you like to have an asset manager or an asset manager in your portfolio? All right, so let's get started with Brookfield Corporation, BN. So Brookfield Corporation is the mother of all the other Brookfield companies. So it's important to understand that it is an alternative asset manager. So what's an alternative asset manager? It's a business that invests in companies that are or projects that requires a unique expertise, and they share like many characteristics such as like being a large projects with several layers of complexity, that the money must remain invested for decades to generate a substantial cash flow. So you may be thinking about like an electric power plant, for example, or an office tower downtown New York. That is like a little bit more complex to invest in that, and you need to leave your money invested for several years before you see some serious cash flow. Most of those projects will perform well over time. So again, a notion of having patient capital. They're not necessarily considered as liquid assets. Again, think about like, yeah, I do have an electric plant to sell. I mean, it's not that easy, right? You don't have like to put like a for sale sign, wait a weekend, and then you're going to make the money back. It's probably going to take a little bit more longer. And most importantly, and more interestingly, is that those projects are not affected or directly affected by economic cycles. Again, they tend to be recession resistant. Again, the electric power plant will likely going to continue to generate powers and sell that power to clients. I mean, if you're thinking about a bridge, pretty much the same thing. Economic recession or not, people are going to take the bridge. They're going to be like a toll be paid, and that's how it's going to happen. So Brookfield Corporation is specialized into this. The business owns multiple other smaller businesses. So you have like Brookfield Renewable that is owned 47% by Brookfield Corporation. You have Brookfield Infrastructure that is owned 27%. And then the company has also 65% ownership into Brookfield Business Partners. It owns completely its Brookfield Property Group. So the real estate, it used to trade right around COVID. They kind of like bought back all the units and then put that as private. right after all the real estate prices dropped. So that was kind of like a good move for them. And they also have Brookfield Asset Management, which is owned at 75%. So when you're thinking about what's the difference between investing in Brookfield, BN, and BAM, well, if you invest in Brookfield Corporation, you own 75% of BAM. So you're not going to see it because, as you can imagine, that is like an ultra complex structure, but you own most of it. So they just spin off a tiny portion of BAM. And the reason why they did is quite simple. So BN is an asset heavy manager. So what's an asset heavy? It means that it will get the money from pension plan, from investors, retail investors, companies, banks, investment firms, so institutional investors as well. And then they will charge a fee to manage that money. So they create funds. They, let's say, invest into infrastructure or into like real estate or into private credit, for example. And they amass like, I don't know, like 100 million. They create a fund and then they charge a fee on that. So that's like the asset light part of it. The asset heavy is that Brookfield Corporation is also using its own capital to invest in those funds. So a portion of the fund is not being funded by retail or institutional investors, but rather by the company itself. So whenever they sell that famous electric plants, they're going to make a profit on it, and it's going to be beneficial for their clients, but also for themselves, which is a big difference with BAM, because Brookfield Asset Management, BAM, is an asset light, meaning that they're doing exactly the same thing as Brookfield Corporation, just creating those funds, gathering the money, and then charging a fee. So super predictable, highly recurring, and pretty much stable as well, in a sense where most institutional investors are not going to buy and sell funds all the time. They're going to stay there for a while, but they do not invest their capital. So if they make a mistake and they make a bad investment, they will not suffer the loss, only their clients. So of course, there will be kind of like a reputation dent, but it's not going to hurt their revenue stream as opposed to Brookfield Corporation. If you look at the yield, that's pretty much like, besides the business model, the yield is probably the thing that makes a big difference between Brookfield Corporation and Brookfield Asset Management. So BN, you're going to be a bit disappointed. This one offers a yield of a yield of 0.62. So not even 1% for BN. But if you look at BAM, well, then if you're happier having a little bit more income, this one pays a yield of around 3.2%. Keep in mind, when you think in total return terms, it's not going to make any difference, but some people just love to see those dividends being deposited, so they will go for BAM for that reason. But chances are BN is likely going to outperform BAM over the long run. I say that for two reasons. The first one has a little bit more the profile of a low yield, high growth stocks. And the second reason, most importantly, is that it is more diversified. So technically, they should be able to have ways to make money during any type of economic environment, while BAM will see their assets under management going down if there is a lot of panic into the market. So it will have affect Brookfield Corporation, but since they have their own capital invested into those projects, it may generate a little bit more returns over the long run. Having said that, both companies shows a good profile in my opinion. The major downside, and I keep repeating this for everyone because it's a big one, the fact that the structure is highly complex. There's a lot of like numbers that you have to rely on management to trust them. So if they ever, I don't know, make a boo-boo, an accounting boo-boo, it's going to hurt big time. That could, like, this is the type of story that could turn sour very quickly. So I just want to highlight this once again. If you are not willing to take that kind of risk when you invest in a stock, to trust management and to have like a kind of like a little bit of like opaque financial statements, very hard to read between the lines because there's a lot of information you don't really have access to. So you have just to trust what you're being told by the business. Well, maybe it's not the right type of company for you. So this is like a huge risk. You have to be very careful about that, of course. But that's it. So if you want to go a little bit deeper and understand the structure of each of the Brookfield family, you just have to go to moosemarkets.com/newsletter, and you'll be able, once you subscribe to the newsletter, you will get a link where you can download the Brookfield family report, which will walk you through every business model that is being traded on Canadian market, which is pretty cool. So, all right, Moose, that's enough for today. Tomorrow, we are going to talk about the dividend payout ratio, which seems to be super simple, but it is actually incredibly complex. And we're going to talk about that tomorrow. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.